Don, the floor is yours.
Okay, thank you, Elke, and hello, everybody. Yeah, we're going to talk a little bit about cash balance plans. First on the agenda, though, is I was going to tell you about the new updated plan limits. So once per year, the limits that you can contribute to plans, pays that are considered, etc., are updated. They just came out about 4 days ago, so we'll go over those briefly. Then we're going to talk about what is a cash balance plan, who are good candidates for a cash balance plan, what's required from a compliance testing point of view, a few case studies, and then answer any questions you may have. So with that, we'll review these limits. There we go. Yeah, I guess the first thing is notable, almost probably most of you have a 401k plan, and those first three items are important to you. I guess the deferral limit, it was 22,500 salary deferral limit each year. That was 2023 is bumping up by $500 to 23,000 in the year 2024. Interestingly, the catch-up contribution of 7,500 is remaining the same. Now, the reason for this is sometimes the CPI, which is used to increase these numbers, doesn't hit the $500 increment required to increase that amount. So that's why the catch up stayed the same. Next year, even if CPI is low, you might see that bump to the 8,000. Then the third item is the defined contribution annual addition limit. Well, how much can you possibly save for an individual in a retirement plan during a year? And that amount increased from 66,000 to 69,000. So those three were specifically related to defined contribution plans. The next one, annual compensation cap, that's related to all retirement plans. Basically, you can't use more in our calculations than 345,000 for the year 2024. That was 330,000 for the year 2023. So if somebody made more than that, 500,000 a year, for example, we can only use 345,000 this coming year in calculating benefits and so forth. Something that applies to everybody is the taxable wage base. That bumped up from 160,200 to 168,600. Now you know that that's your Social Security taxes, and that's the amount that you pay the retirement portion of that tax on. There's two pieces in the FICA taxes. One piece is retirement, the other piece is Medicare. The retirement one of 6.2% of pay goes up to the 168.6 this coming year. The Medicare one, the 1.45% of pay, goes all the way up. There's no cap on that particular one. Then one I'm going to introduce new to you, unless you happen to have a cash balance plan, is the defined benefit DB annual limit. That's bumping from 265,000 to 275,000 a year. Basically what that says is you're allowed to fund for a pension benefit, assuming your pay and service can support it, of up to $275,000 a year. Now, why that's unique is because the contribution required to fund for that benefit can be extremely high in the later years of your life. Age 60 and plus, for instance, is a very significant amount, over 300,000 per year. As you're younger, that contribution requirement declines slightly. Then we have, I'm going to skip the 457B contribution limit other than to note it went up. That's the same as the salary deferral limit. That's for not-for-profits possibly or governmental plans, but it's their version of 401k. The last important one from my perspective is the highly compensated employee. That's bumping from 150,000 to 155. Now this one's kind of unique. It operates a little different than the others. If you were if you made more than 150,000 in the year 2023, you're actually highly paid for 2024. If you make more than 155,000 in 2024, you'll be considered highly compensated for the year 2025. So it's kind of a little bit of time difference in terms of recognizing a highly compensated employee. Now, why that's important is the government has rules. We're going to go through a few of them, but the government has rules that say you can't favor highly paid people more so than others. However, you could not favor them should you want and if it makes sense for your plan. So that's the significance. When we do all this testing that I'm going to be briefly describing, what we're really doing is comparing the benefits of the highly paid to the benefits of the non-highly paid and making sure they're proportionately equal. So those are the limits. I don't know if you've seen them yet, but they're brand new. So the next slide is, well, what is a cash balance plan? A cash balance plan is a type of defined benefit plan. Now, there's two broad types of plans. Defined benefit, that's where you define what you will get when you retire, versus a defined contribution plan, most commonly a 401k, which is where you define what you can contribute to the plan, and whatever that turns out to is what you get at retirement. So that's the fundamental difference. So when you think about that, I guess what you think about is investment returns. In a defined contribution 401k plan, investment gains or investment losses are the participants' issue to deal with. Once the employer made the contribution, it's on the participant's shoulders from there. In a defined benefit type plan, it operates differently. There's a credit or a contribution just like a profit sharing might have. But if investment performance doesn't perform to what that plan projects or states, then the employer makes additional contributions to square it up. Alternatively, if the plan earns more than that, the employer can reduce contributions and still provide that same projected benefit. So those are the big difference between cash balance that's going to look a lot like a profit sharing plan, but it's technically a defined benefit pension plan. So what happens is every year you have a credit or a contribution credit. And it might be 100% of pay for an owner, or it might be 5% of pay for a non-owner. That's all defined in the plan after we do all of our testing and discrimination testing. So, but it basically, you say, here's your credit. I'll use an example, $5,000. And then next year, I'm going to receive a statement that said my $5,000 earned 5% interest, and I get another $5,000. So I have my initial 5,000 plus my interest credit stated in the plan, not what the actual investments earn, and then another credit on top of that. And that grows so that you know at retirement exactly what you'll have. So it shows that each year. It's usually added. These cash balance plans are somewhat unique. They're not for everybody, but they work extremely well for many. Uh, but they're often added as a feature or as an additional plan with the 401k plan, because we use those two plans together to pass all of these tests I'll be describing a little bit later. But I guess my point here is it's a way to save if you happen to be very successful. You have extra money, you're behind on your savings possibly, and you want to set aside much more for retirement. It's a way to do that. As an example, if I'm in my 60s, I can probably save up to $300,000 a year in a cash balance plan. If I'm 50, it might be 180,000 or so. And if I'm age 40, 110,000. So you could see how the contribution credit is based on not only pay, but also service and most importantly, age. So who are good candidates for a cash balance plan? I guess the first thing you need to know is, well, you have to be financially successful, your company, because you're making a promise. Now you can always amend the promise from time to time, but fundamentally you're making a promise or a commitment to provide this retirement benefit into the future. So you want to make sure your company is stable and financially successful to afford that. Nobody wants to see somebody overextend in terms of overpromise what they can reasonably fund. So your income has to be somewhat predictable. If it's real volatile, sometimes we have employers come that say, whoa, I had a windfall this year. I'd like to save as much as possible. And we say, well, what about next couple of years? I'm not sure. That's a little dangerous because you are committing to a program, and that program's intended to be permanent. Uh, that's somewhat subjective, but we generally think in terms of 3 to 5 years. You should be in a high tax bracket because that's the whole purpose of the plan. Is you want to be able to have Uncle Sam help you with this funding this plan by taking a deduction for these contributions. I sometimes forget why it's so important to have retirement savings, whether it's 401k or cash balance pension or some other vehicle, is because you have that immediate tax deduction, very positive. Hopefully you'll be in a lower tax bracket when you retire. So that's a leverage that helps you accumulate money. While you are accumulating through your working years, the income tax is deferred on the investment gains. So there's a big advantage here in that if you invest outside of a plan, you're paying gains and so forth and taxes on your investment results, where within a plan, that is not taxed at that time. So you get to hold on to it and invest it and compound your earnings. The last thought on the candidates for cash balance plan is there should be an age differential. Generally, you want your older, the people you want to favor the most to be your older employees. So if you have if you're a young person and you have an old staff, a cash balance isn't for you. If you're an older person and you have a younger staff, cash balance plans can work out very favorably. Let's just briefly talk now about compliance monitoring then. Oh, there's several different tests that we have to coordinate, I guess you'd say, to make sure that they're all passed so that you can offer the benefit program that you desire. The first one is minimum participation. In other words, this plan has to provide meaningful benefits, and the IRS describes that or defines that, meaningful benefits to at least 40% of your workforce. One of my examples that we're going to go through, my case studies, I show you a plan where they exclude some people, and they're allowed to do that because they still satisfied the 40% meaningful benefit rule. So that's hurdle number one. Hurdle number two is the average benefit percentage test has to be satisfied. And basically that just says the average benefits projected for non-highly compensated employees, those are the non-highly paid, are at least 70% of the average benefits for the highly paid. A lot of complex calculations go into it, but that's the concept. They have to be close to the highly paid. Then there's a minimum allocation gateway. You have to make a certain commitment to even go into these testing rules. And that's generally 5% of pay. It can be as little as 5% of pay or as high as 7.5% of pay. Rate group testing, that's just, again, another one of those tests that you have to show that some of your non-highly paid are receiving benefits at least as valuable as the highly compensated employee. And we do each highly compensated employee separately and prepare these tests. Lastly, there's some deductible limits. We want to make sure that we monitor those. There are limits, even though I already threw out some very large numbers, and you're going to see large numbers, but there are limits that we consider when we design these plans. And lastly, if your plan's top heavy, That's when more than 60% of the value of the plan is for key employees. If you do have most of the money going to key employees, which is often the design or the goal, then you have to have a minimum benefit offered to the rank and file. Well, let's look at an example then. So with all that as kind of background, the first one I'm going to use is probably the most typical situation we see. We have an owner who operates a small successful business. In my illustration or my case study, he or she is age 60 years old. There's two employees, one's age 27 and the other's age 55, so kind of a mixture in ages, and they each earn $45,000 a year. Now, the owner hasn't saved sufficient retirement plan assets and he'd like to really catch up or save a lot. So, and he also has been taking, I keep using he and I shouldn't do that, but he or she has been taking a low W-2 pay, and it happens to be a sub-S corporation, so they take greater dividends. And that's done primarily for Social Security tax purposes. But sub-S distributions can't be included by us in determining the testing. So we do need a W-2, a higher W-2 to support testing and also the contributions we might desire. So the question is, that's my situation, what can be done? Well, we looked at, on the next slide, we looked at, well, what do they have currently? Most companies, a lot of companies, already have a 401k plan. And many companies use a safe harbor contribution. Now, you know there's two safe harbor contributions. One is to promote savings, which is the matching contribution. That's where you would contribute dollar for dollar or match dollar for dollar on the first 3% of pay, and then 50 cents on the dollar on the next 2% of pay. So if it's the matching safe harbor, it could cost you as much as 4% of pay if everybody is saving 5% of their pay. Alternatively, you might say, I'm not using the matching safe harbor. I'm going to just give everybody 3% of pay. That's my safe harbor contribution. In which case, both of them satisfy the safe harbor requirement for a 401k plan. However, we usually recommend that you use the 3% safe harbor if you're considering a cash balance pension plan, because I can use, or we can use, that 3% in our non-discrimination testing. We cannot use the matching formula. So that's why most of our cash balance clients either have moved or already had the 3% to pay safe harbor contribution. In this particular case study, this one did. Then all employees can take advantage of the 401k feature, whatever they want, up to the annual limit out of their pay. Now, in this particular case, the owner receives a cash balance credit of $300,000 annually. The owner is age 60, so that's why we can see such large amounts. And in this example, the employees receive 2.5% of pay, or $1,125 each, for a total of $2,250. If you stop there, you say, holy smokes, this is a tremendous benefit for the owner and at a modest benefit for the rank and file. They aren't always this much difference, but they can be. But we can't pass testing if we just stop there. So we go back again and look at, well, what profit sharing do we need to give to the staff to satisfy all those compliance tests that I described earlier? In this example, the staff received another 4% of pay in the profit sharing as a profit sharing contribution, and the owner could get another 2% of pay. So the profit sharing in a cash balance combo plan relationship, the profit sharing is the feature that you use to pass testing. So the last results, I guess, is to kind of do an overall summary of what this looks like. The overall summary is there's a total employer contribution of 322,300, 313,750 goes to the owner. The tax savings are estimated at 128,920. We're assuming a 40% federal and state combined tax rate. We know the highest rate is 37%, and we assumed a 3% for the state. So when you look at this, it really, if you did some math here, what you would find is after tax savings, there's a net cost of cash flow of 193,380. So that was case number one. Now, if you didn't have any employees, you just drop them off and all the testing kind of goes away. It's interesting. A sole owner employee can really have almost whatever they want up to the limits within their cash balance plan. This second situation is slightly different. It's a larger company. It's a trucking and warehouse business. Happen to have two owners, their spouses are employed, and one daughter of one of the owners is also employed. The owners are older, in their mid-60s. The total payroll for all of the family members is 850,000. There's also 67 other employees. So 67 other employees at various ages, as young as age 22 and as old as age 70, but a variety of ages of the 64 employees. And the total payroll for the non-owners are 3,120,000. So there's a significant difference. It's hard to, in a profit sharing plan only, to benefit the owners very significantly just due to the differential in the pay, how much pay and how many bodies there are in the retirement plan. But they offer a plan. It's a 401k, and they offer the 3% safe harbor, and they also have a discretionary profit sharing feature, which they have been doing in the past. So their question to us was, well, this is working okay, but we're starting to get to that age where we really need to set aside some money, and our business happens to be very strong and is projected to be strong. What can we do with a cash balance plan? So what we did is basically we designed a plan that offered benefits to the owners, the spouses, and the children, administrative staff, and warehouse staff. The plan excludes truck drivers and the sales team. So there were 27 included and 39 people excluded from the cash balance plan. That satisfies the minimum coverage and the meaningful benefit test. Then we said the cash balance plan was added and provides benefits of 690,000 to the owners and the family. And in this case, it was 2% to pay to the eligible staff. Total cost of 27,300. So far, so good, a great result. However, we have to go back and provide additional profit sharing for all the staff equal to 5% of pay in addition to their 3% safe harbor. So the total cost for that profit sharing is 330,000. The owners received a portion of that 330. Oh, I'm sorry, the owners also received 82,700. Now this company was already doing some of that 5%. They were doing the 3%, they had to, and they were also doing some of the 5% already. So they're kind of looking at it as this cash balance just lets us keep a similar program to what we had for the staff, enhance them a little bit with a cash balance account, but it really allowed the owners to save quite a bit more. When all is said and done, the owners had 800,000 of contributions, the staff 330,000. So they estimated tax savings were 452,000 based on the combined rates, and that was the result of the plan. And they were actually thrilled with this plan. And then they went on to say that We also could anticipate forfeitures. So all retirement plans other than the safe harbor have a vesting schedule. Cash balance plan can have a 3-year vesting schedule. Profit sharing typically is a graded going up to 6 years. But as people leave, and if they're not vested, then what happens with that money is it's used to make the next year's contributions. So it kind of rolls up to benefit those people that stay. So for those reasons, they concluded this is a good plan for them. So that's study number 2. I included it only to show that there are times when there's more to be there. The plans can work more than just a tax shelter for a small or sole proprietor. The last slide, Elke, I think we skipped the last example. Maybe I'll just go to that. Last example. There we go. This is a little different situation. We've seen this a few times this last year. Over the year we do, I know I personally have done close to 400 different illustrations for companies. They don't all take a plan, but we provide these for free. At least, the first several illustrations, we provide them for free to give you an idea to see, does this make sense for me? And I'll talk more about that in a little bit. But this particular case, we have a law office that has 3 partners, 1 older founder and 2 younger partners. I should just talk about the requirements. You have to establish these kind of plans while the person's working. You can't establish it after they retire and then use this to buy them out. They have to accumulate the money while they're working. They need they need to be a little bit older, and they need income to support this amount. You also want to make sure it's in your buy-sell agreements so that that this is considered when recognizing how much you want to buy out that older partner. So our 2 younger partners in this example want to buy out the founder, the older partner, over the next 5 years. They each have 33% equal partnership, and the estimated buyout for the founder owner is $1.5 million. So what they looked at is they said, well, what if we set up a cash balance plan and fund the older partner $300,000 a year? Now I modified the example to make it a nice round number, but $300,000 for 3 people would work out $100,000 a year per person. So on the next slide, we talk a little bit about how these calculations worked. So the contributions to fund the retiring partner cash balance account is $1.5 million, $300,000 over 5 years. It's $100,000 funded by each partner. So the founder is also funding his buyout. So we exclude that, and we only counted the $100,000 each for each of the younger partners. And they ended up funding 1 million of the 1.5 million founders balance. So the founder has a balance at the end of the year, 1.5 million. It's actually a little higher because there would be interest on that. But 1.5 million. So now the young partners over that 5-year period have not received their portion of profits and instead use those to buy out the founding partner. Now, when the founding partner leaves, he has a nice retirement account balance that's protected and in a retirement account that he'll take out as distributions over his retirement years. And the remaining balance will be still considered in the buyout document, the purchase agreement of 500,000, but a much more manageable number because they've really used tax savings to help significantly in building this buyout. I excluded from this example any employees. If there are employees, we have to build them in and make sure that they're receiving a meaningful benefit as well. But for simplicity purposes, I excluded them. So at the end of the day, the 3 partners shared in a $1.5 million state and federal income tax deduction over 5 years. The younger partners buyout amount was reduced from 1.5 million to 500,000. The founder receives his 1 million of buyout proceeds plus interest in his retirement account, in addition to what he funded. And the founder would pay capital gains on only 500,000 that are required, not the 1.5 million at the buyout. So estimated tax savings in this example at the highest rate, the 40% combined rate, is $600,000 over that 5-year period. So this worked out very nice, and it's a way for an owner to get some value out of his business. Sometimes it's difficult to get value out of your business. This is a tax efficient way of doing that. So with all that said, I guess if you're interested, if you heard anything here that you think is interesting, or if you'd like to look at a plan just to see if it makes sense for you, you would reach out to one of our regional sales consultants. We have them across the country, and they're skilled enough to gather information from you, tell you what census information we need. They gather information about, well, what are you trying to accomplish? And then they send it to the team I'm on, the actuarial team. And what we do is we design the best possible plan to satisfy your objectives as close as we can. And that would be the process. Then that's delivered back to you. You look at it and say, well, that's too rich for me, or that's not rich enough for them, et cetera, et cetera. If it's suitable, then we go ahead and implement the plan, and we can administer it on an annual basis. So that's pretty much everything to talk about on a cash balance plan. We could talk a lot more about testing, which is interesting to guys like me, not so interesting to everybody else. But I hope that I gave you some overview of when you should look, and if you want to look, how do you go about doing that?